Welcome to the Radio Revenue Podcast. Today we're doing a deep dive into something really fascinating from the business world, something that maybe flies under the radar for a lot of people.
Yeah, absolutely.
We're going to unpack the inner workings of a major interactive entertainment company. And we're basing this all on their recent Form 10-K filing. That's for the fiscal year ended March 34, 2025.
Right, the official stuff.
Exactly. So our mission today is pretty straightforward.
Yeah.
Cut through all that corporate jargon, and highlight the crucial financial insights, the strategic plays, and importantly, the key risks that define this multi-billion-dollar entity.
Kind of like a shortcut to understanding a gaming giant.
Precisely. Think of it like that. And just to be clear, we're sticking entirely to this one SEC filing. It's dense, packed with detail, but we'll pull out the important bits for you.
Straight from the source.
All right, let's begin by just taking in the sheer scale of this company. I mean, the filing immediately tells us they're a well-known seasoned issuer and a large accelerated filer with the SEC.
Which sounds technical, but basically means they're big, established, and under a lot of scrutiny.
Exactly. For you listening, it means they're among the largest, most transparent, most frequently reviewed public companies. Their presence is just massive.
Yeah, and what's immediately striking is how vast. Get this. As of the last business day of their most recently completed second fiscal quarter, the market value of their stock held by non-affiliates. So the public float. It was approximately $26,579,762,843.
Wow. So over $26.5 billion.
Over $26.5 billion, yeah. And then as of May 5, 2025, they had like 177.4 million shares of common stock out there, net of treasury stock.
Okay, these aren't just big numbers.
No, they really signal, immense public trust, significant liquidity, a really widespread investor base. It's a big deal.
That kind of valuation definitely sets the stage.
Yeah.
So with that kind of scale, how did they actually do in their most recent fiscal year? What was the performance like?
All right, let's connect it to performance. If we look at their recent results, total net revenue for the fiscal year ended March 31st, 2025, it hit $5,633.6 million. That's up from $5,349.6 million the year before in 2024. So a solid 5.3% increase year over year. Nice growth.
Decent growth, yeah.
But here's where it gets, I think, really interesting. Their gross profit, it surged, like really surged, by 36.6%.
36%, wow.
Yeah, it jumped from $2,241.8 million in 2024 up to $3,062.2 million in 2025.
Okay, so that's not just about selling more stuff.
Exactly. It isn't just growing revenue. It shows a pretty significant improvement in, let's say, their operational efficiency, their profitability on core sales.
They're keeping more of each dollar.
Much more. They're not just selling more. They're keeping a much bigger slice of each dollar earned.
Yeah.
That's huge for the bottom line.
That jump in gross profit certainly catches the eye. Okay, so beyond those top-line numbers, how does a company this big actually function? How does it generate that kind of revenue? What are the core strategic pillars holding this up?
Well, a critical insight from the filing is really in their business model. I mean, the overwhelming majority of their revenue, $5,167.5 million in 2025, comes from game sales.
Right.
That just dwarfs their advertising revenue, which was like $466.1 million.
Okay, so games are king.
Absolutely. But what really defines their revenue stream, I'd argue, is its digital nature. Get this. A massive $5,431.8 million out of their total $5,633.6 million net revenue in 2025 came from digital online services. So that's your digital downloads, online platforms, cloud streaming, all that stuff.
And physical retail, the boxed copies.
A tiny fraction in comparison, just $201.8 million.
Wow. So this isn't just a trend for them, it's like fundamental.
It's fundamental. It's a complete overhaul of their business model, really. Think about it. They've basically cut out a lot of the physical distribution costs, right?
Right, logistics, manufacturing.
Yeah, and they've built direct relationships with millions of consumers. Plus, it opens the door wide open for recurring revenue. Live service games, microtransactions.
Which is where the real money is often made long-term these days.
Exactly. It's a powerful leverage point for profitability. But, and this is a big but we'll probably come back to, it creates this immense reliance on platform owners.
Or also their competitors. We'll get there. So digital is basically everything. That kind of focus needs a specific workforce, right? How do they manage their people, their human capital?
Right.
And how do they keep the hits coming? Product pipeline.
Yeah, good question. They report having 12,928 full-time employees as of March 31st, 2025. A substantial number.
Yeah.
But what's really striking is that 10,096 of those folks, nearly 80%, are focused purely on product development.
80%. That's a huge investment in R&D, basically.
It really underscores the project-based, hit-driven nature of this industry, you know? You need the creative talent, so they emphasize attracting and retaining that talent. Strong culture, competitive pay, good benefits, development programs, all crucial when everyone's fighting for the best developers.
Makes sense. And the product side,
Yeah.
how do they manage that pipeline?
The filing talks about a disciplined approach to product investment, which sounds corporate, but it means they're constantly evaluating new game ideas, rigorously reviewing games already in development, and then meticulously assessing how they perform in the market after release. It's like a multi-stage filter designed to push forward potential blockbusters and, just as importantly, cut losses on things that aren't working out.
A disciplined funnel. Okay, that emphasis on talent and process makes sense,
Yeah.
especially with, like you said, the hit-driven nature.
Yeah.
But how do they plan to get even bigger? Let's shift to their growth strategy, because that's where you see the vision for, new markets expanding the empire.
Right. Growth. They're clearly focused on innovation, identifying new trends, investing selectively, as they put it, in emerging platforms, technologies, business models, and geographies.
Geography is interesting. Where are they looking?
A significant part of this is expanding internationally. Specifically, Asia, the Middle East, and Latin America seem to be key focuses. China is mentioned as their most established international market. They offer games like NBA 2K Online and Civilization, eras and allies there, but notably through a partnership with Tencent.
Ah, the partnership model. Necessary in some markets.
Very necessary, especially China. It's not just selling games, it's navigating really complex local regulations and leveraging established players like Tencent. It shows real global ambition.
And acquisitions. Are they buying growth too?
Absolutely. That's another big piece. Their global ambition is underlined by a recent major acquisition, the Gearbox Entertainment Company. They bought them on June 11th, 2024.
Gearbox. Okay, big name. What was the deal value?
Initial consideration was stock, valued at around $410.4 million. And the filing makes it clear this wasn't just about adding revenue. It was specifically aimed at strengthening their creative talent pool and getting more intellectual property, more IP.
So buying talent in future hits, essentially.
That seems to be the strategy, yeah.
Yeah.
Deepening the content pipeline.
Okay, ambitious growth plan. Makes sense.
Mhm.
But no company, especially one this big, playing on a global stage, operates without challenges. Let's talk risks. What are the major hurdles, the big dangers they face?
Yeah, risks are definitely there. A significant one, and it's kind of a classic frenemy situation, is their dependence on the hardware licensors. Think Sony and Microsoft, PlayStation and Xbox.
Right, the console makers.
Exactly. These companies make the platforms their biggest games run on, yet they are also direct competitors in the gaming space, right? They have their own studios, their own services.
So our company needs their permission, basically.
They need approval to publish titles on these platforms. That gives Sony and Microsoft immense leverage. They can influence release dates, the cut they take from sales, even how visible a game is in their online stores. It directly impacts revenue.
That's a tricky position.
Very. And similarly, they get substantial revenue from third-party mobile and web platforms. Apple's App Store, Google Play, even Facebook.
Also competitors.
Also direct competitors who, again, control the distribution, can change the fee structures, alter policies, sometimes with very little warning. It's a constant tightrope walk, relying heavily on partners who are also rivals.
That's a fascinating power dynamic. Really highlights the platform control issue.
Yeah.
What about just straight-up competition beyond the platform owners?
Oh, it's intense. They face competition not just from other traditional game publishers, the usual suspects,
Right.
but also from the tech giants, Apple, Google, Microsoft again, who are seriously beefing up their own interactive entertainment arms. They have deep pockets.
And it's not just games competing with games, is it?
No, absolutely not. That's a key point. They're competing with other forms of entertainment entirely. Movies, TV, streaming services like Netflix, social media like TikTok.
Anything that takes up leisure time and money.
Exactly. It's a battle for consumer attention and spending. In today's world, a gaming company isn't just competing with another game launch. It's competing with a new season on HBO, scrolling Instagram, maybe even just deciding to go outside. Every dollar, every minute of free time is contested.
That really broadens the competitive landscape. Okay, so beyond those market forces, what about their internal structure? Financial risks, the challenges of just being so big and global.
Well, they do carry a significant amount of debt. The filing shows $3,650 million in senior notes outstanding as of March 31st, 2025.
$3.5 billion in debt. Okay.
Yeah, think of these like long-term loans from investors, and that carries risks, right? Like needing to refinance that debt when it comes due, maybe at higher interest rates.
Uh-huh.
And they have to comply with specific rules set by the lenders, these covenants. If they don't meet certain financial metrics, those covenants could restrict what they can do financially or strategically.
So less flexibility potentially.
Potentially, yeah. And then there's the international side. It's huge for them, accounted for 39.5% of their net revenue last fiscal year, almost 40%.
Wow.
But that global footprint exposes them to a whole web of risks. Credit risks in different countries, tariffs changing, big currency fluctuations. The filing actually specifically calls out Turkey as a jurisdiction for currency risk.
Interesting detail. Highlights volatility.
It does. And then you have potential shipping delays, though maybe less critical with digital focus, but still a factor. And broader geopolitical stuff, the Russia-Ukraine war, the Israel-Hamas conflict, I mentioned these can impact sales, supply chains, consumer sentiment.
Yeah, global instability is a real factor.
Definitely. And on top of all that, just the constantly changing laws and regulations everywhere. Gaming rules, data privacy, content restrictions, taxes. It's a constantly shifting global regulatory maze they have to navigate.
It really sounds like a complex global balancing act. Okay, it's clear they face this intricate web of risks. Let's dive a bit deeper into some of the more technical financial stuff now. How they actually account for things. What can that tell us about the business itself?
Okay, yeah, the accounting policies are actually quite revealing about the sort of unique economics of gaming. Take revenue recognition, how they book sales, it varies quite a bit.
How so?
Well, for a full game you might download, one that has both offline play and significant online services, think like a big console game with multiplayer.
Right.
They actually split the revenue recognition, the price you pay up front for the game license itself. They book that revenue immediately.
Okay, that makes sense.
But for the online service part, the ongoing multiplayer access, live updates, maybe future content passes you bought, the revenue from that gets deferred. It's recognized ratably, meaning smoothly, over time, across an estimated service period.
And how do they estimate that period?
They calculate it based on something they call user life, which is basically their estimate of how long the average player typically sticks with that game's online features.
So it's an estimate based on player behavior.
Exactly. And for purely online games where there isn't really an offline component, all the revenue gets recognized over that estimated service period. Same goes for virtual currency and in-game purchases. That revenue is also deferred and booked over the estimated user life. It's their way of matching the revenue to the ongoing service they provide.
So a lot of estimation involved, especially in this live service world we're in. Makes sense. But what about impairments? That seemed like a really big recurring theme in their financials. What does that tell us about volatility?
Yeah, impairments. This is a critical point, and it really, really highlights the inherent risk and volatility in gaming. Their goodwill impairment, for instance, it was massive, $3,545.2 million in 2025.
$3.5 billion. Just in goodwill impairment.
Yes. And it was $2,342.1 million in 2024. So huge numbers, 2 years running.
Okay, remind us what exactly is goodwill in this context.
Right. Goodwill is basically the extra amount a company pays when it buys another business, above the fair value of the actual assets it acquired. It represents intangible stuff like brand reputation, customer lists, expected synergies.
The good stuff that isn't on the balance sheet otherwise.
Kind of, yeah. So an impairment means they've had to officially admit that the future value or earnings they expected to get from a past acquisition or from a segment of their business, a reporting unit, isn't going to happen as planned.
So it's a write-down, a big one.
A very significant financial write-down. It signals that past investments, often acquisitions, aren't paying off as they'd hoped. Maybe because the games from that acquired studio underperformed, or maybe their own strategy changed.
And it wasn't just goodwill, right?
No. Beyond goodwill, they also recorded impairment charges specifically for developed game technology intangible assets. That was $137.0 million in 2025. And also for branding and trade names, intangible assets, another $39.3 million in 2025.
And why were those impaired?
Primarily due to reduced forecasts for certain games. Could be because of broader industry conditions slowing down, or maybe internal strategic changes that shifted focus away from those specific games or brands.
Wow. Really shows how hard it is to predict which games will be long-term hits, doesn't it?
Absolutely. A game that looks like a surefire blockbuster on paper might just fall short of expectations, forcing them to reevaluate its carrying value on their books. Huge volatility.
That really drives home the unpredictability, even for a giant player like this.
Mm.
Okay, so as we kind of wrap up this deep dive, let's pull it all together. What are the core takeaways? If someone wants to understand this business, what are the absolute essential nuggets?
Okay, key takeaways. I'd say number one, this is a large, growing, interactive entertainment company. That's clear. Number two, they've successfully pivoted to being heavily reliant on digital distribution.
Digital dominance.
Yeah. Three, they're continuing to expand internationally using strategic acquisitions and partnerships. Four, while their gross profit is jumping up, which is great, they face significant competitive pressures, not just from games, but all entertainment, and really substantial operational risks, especially that reliance on competitor-owned platforms.
The frenemy platforms, yeah.
Exactly. And finally, their financial reporting itself highlights the complexities, both in recognizing revenue in this live service digital world and the very real, very large impact of these goodwill and intangible asset impairments when growth forecasts change or big titles underperform.
So a dynamic, high-stakes environment.
Extremely dynamic, high growth potential, but also high risk.
Which definitely raises an important question, maybe something for you, our listeners, to think about. Given this company's ongoing strategy of acquiring studios and IP, and how much they rely on needing that steady stream of hit titles, what are the long-term implications for a company this big if a major product really tanks? Or if they face unexpected regulatory problems in one of those key international markets?
Yeah, how resilient is that model to a major shock?
It's a complex balance of ambition and risk, for sure. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.